All right, let's talk about something every single options trader runs into. You've got your analysis done, you're ready to make a move, but then you're faced with a choice. How do you pick the perfect put option?
I mean, you pull up an options chain and bam, it's just a wall of numbers staring back at you. Dozens, sometimes hundreds of different strike prices, different expirations. It's overwhelming. So how do the pros cut through all that noise? How do they find that one single contract that gives them the best possible edge?
Well, here's the secret. They don't guess. They're not just throwing a dart at a board. They use a map, and that map is called market structure. It's this incredible way of seeing the hidden levels of support and resistance that pretty much tell you how a stock is likely to act. And today, we're going to learn how to read that map.
So, what are the key landmarks we're looking for on this map? It really just boils down to two absolutely critical levels that professional traders watch like a hawk.
First up, you've got the put wall. And you should think of this exactly like it sounds. It's a giant structural floor under the stock's price. It's a strike price where there is such a huge pile of put options that the market makers, the big firms who sold all those puts, they are basically forced to defend that level. As the stock price drops towards the wall, they have to start buying the actual stock to hedge themselves. And that buying pressure creates this incredibly powerful support right at that price. The second big landmark is called the gamma flip. This one is the ultimate dividing line. Seriously, think of it as a line in the sand that splits the market into two totally different zones, or regimes. The way a stock behaves when it's trading above this line is fundamentally different from how it behaves below it.
And this is what those two different market weather systems look like. When a stock is trading below its gamma flip, we say it's in a negative gamma regime. What does that mean for you? It means you should expect way more volatility and choppier, more erratic price action. But when it's above that flip point, it's in a positive gamma environment. And here, things calm down. Market makers tend to trade against the short-term trend. They'll buy the dips and sell the rips, which just smothers volatility and leads to much more stable, predictable movement. The big takeaway here is simple. You absolutely have to know which regime you're trading in before you even think about placing a trade.
Okay, so theory is great, right? But let's see how this stuff actually plays out in the real world. We're going to map out a trade to sell a put on Bank of America for the April 17th expiration. But as you're about to see, sometimes the map leads you to a place that doesn't seem to exist. All right, so here's the lay of the land for Bank of America. The stock's trading around $46.74. The gamma flip is way up there at $49.54, and that big defensive put wall is sitting right at the $45 strike.
So what's the story this data tells us? Well, with the stock price well below the gamma flip, we know for a fact BAC is in that choppy, volatile, negative gamma regime. And that makes the $45 put wall absolutely critical. In this kind of chaotic environment, that wall is the main structural floor we have to lean on. Okay, so based on this structure, we've got three logical choices for selling an April 17th put. The $45 strike is the most aggressive. Yeah, it offers the highest premium, but you're relying 100% on that put wall to hold. The $44 strike, that's your most conservative, safest bet. And that leaves the $44.50 strike as the sweet spot. It offers a great balance of risk and reward, anchoring our trade just underneath that big $45 defense line. It gives us a small but really crucial safety buffer. Perfect, right?
And here comes the plot twist. A trader does all this work, they found the perfect strike, they go to their brokerage platform to place the trade, and poof, the $44.50 strike is just gone. It's not there. This happens all the time, and it is so frustrating. So what is going on?
Well, this kicks off a little investigation. Why do perfectly logical, ideal strike prices sometimes just seem to vanish from our trading platforms? Let's put on our detective hats for a second and figure this out.
The first suspects are always your platform settings. Seriously, first thing you do, check your strikes filter and set it to all, because most brokers default to only showing a handful. Second, double-check that expiration year. If you accidentally click on a long-term option, a leap from next year, you'll often only see these wide $5 or $10 increments. But if you've done both of those things and it's still missing, then you've stumbled upon the real mystery.
And here it is, the solution to the mystery. Your broker doesn't just invent strike prices. They all come from one place, the Options Clearing Corporation, or the OCC. And the OCC has very specific rules. For a stock like Bank of America trading around $47, the standard interval between strikes is $1. They only add those half-dollar increments like our $44.50 under specific conditions.
usually when the stock's price gets super close to that level, or for very short-term weekly options. So since our April 17th expiration is still a few weeks out and the price is a bit far away, the OCC simply hasn't created that strike yet. It's not a glitch on your platform, it just plain doesn't exist.
So what does a pro do? They don't just throw their hands up and walk away. They adapt. If the perfect strike isn't available, you pivot to the next most structurally sound option. For our Bank of America trade, that means we have to make a choice between that aggressive $45 strike right on the put wall or the more conservative $44 strike just below it. And honestly, the choice just comes down to your conviction in that choppy market.
Now, let's look at another quick example, just to really lock this strategy in. We'll look at a completely different market environment, the XLE Energy ETF. Okay, here's the data for XLE. The price is around $57.70, the put wall is at $55, and the gamma flip is down at $54.09. Notice the difference here right away? With XLE, the current price is trading well above the gamma flip point. That puts us squarely in a positive gamma regime. This is the total opposite of that Bank of America setup. Here, we should expect much lower volatility and way more stable price action because we know market makers are probably going to step in and buy on any little dips towards those key levels.
Now, let's look at our choices for that April 17th expiration. Selling the $55 put is a really solid choice. It's right there on the put wall. But the most structurally sound option is arguably the $54 strike. Think about it. By picking that one, you position your trade just below the put wall and almost exactly on the gamma flip level. That gives you two massive layers of structural defense before your position is even close to being at risk.
So there you have it. We've defined the key terms, we've walked through two real-world examples, and we even solved a common trading mystery. Let's just distill everything we've learned down into a simple, repeatable playbook you can use.
Here it is, 5 simple steps to picking puts like a pro. First, always identify the regime. Is the price above or below the gamma flip? Second, locate your main defensive level, that big put wall. Third, align your strike choice with those levels and your own risk tolerance. Fourth, if you can't find your perfect strike, do a quick troubleshoot of your platform. And finally, number 5, if it really truly doesn't exist yet, you adapt and you pivot to the next best choice.
You see, this whole approach is a complete game changer. It's a shift away from just guessing or picking a random delta. It's about seeing the hidden architecture of the market and using that structure to your advantage. So the only question left is, now that you can see the structure, how are you going to place your next trade?